Thank you very much, Madam President, and good morning to all of you. Thank you, Professor Wieland. I'm actually honored and pleased to be able to follow the tradition that has been established by my predecessors in this position. This morning, I would like to speak to you about the ECB's strategy review, as you alluded to, the reasons we're conducting it, and our expectations as a result of it. Since 2003, when we last conducted the strategy review, the euro area and the world economy have undergone profound changes. The consensus that has governed monetary policy worldwide has been challenged on a number of fronts. Most importantly, from our perspective, the last decade has been defined by a persistent decline in inflation among advanced economies. In the euro area, annual inflation averaged 2.3% between 1999 to the eve of the great financial crisis in August 2008, but only 1.2% from that period until 2019. And this environment poses fundamental questions for central banks. I will borrow from Winston Churchill, who said, "However beautiful the strategy, you should occasionally look at the results." We need to thoroughly analyze the forces that are driving inflation dynamics today and consider whether and how we should adjust our strategy policy in response. To inform this analysis, we also want to hear from a wide variety of stakeholders, including citizens, academics, parliamentarians, and civil society organizations, about how they perceive our goals and our actions. And this is why we have launched the ECB Listens program, in which we will aim to listen to as many voices as possible. As we have just restarted our strategy review, because as you know, we put it on hold when the coronavirus pandemic struck. So as we are just restarting it, I will not be presenting any conclusions today. Now is the time for listening, for reflecting, but I will, in my remarks, discuss the main issues we are looking at and some of the key questions we will be asking. In my remarks today, I will cover three topics. First, the definition of our inflation objective. Second, the relationship between inflation and the real economy. And third, the transmission and effectiveness of monetary policy. Now, none of these issues can be considered in isolation, and we need a well-rounded view of all elements in order to draw conclusions for the strategy review. I start with the inflation objective because it anchors the inflation process for the whole economy. Three issues will feature particularly prominently in our review. I'm just going to pause here for a second just to make sure that the sound that you are receiving is better than the echo that I'm receiving. If somebody can just give me a sign, it's good? Perfect, excellent. So I will carry on. So the first issue is how we formulate the inflation aim. The second issue is the horizon over which price stability should be achieved. And the third issue is the measure of inflation that lies behind our inflation aim. So let me tackle the first one, how to formulate the inflation aim. The arguments in favor of central banks aiming for positive inflation rates with a sufficient buffer away from zero were articulated during our strategy review back in 2003. It compensates for possible measurement bias. It helps countries rebalance their economies within a monetary union, and it creates a buffer against deflation, as well as leading to higher nominal interest rates over the medium term. That helps ensure that monetary policy is not forced too often towards the effective lower bound when faced with shocks that push inflation too low. Now, since 2003, as you know, the ECB has used a double key formulation to set our objective, defining price stability as a year-on-year increase in inflation of below 2%, while aiming for inflation of below but close to 2%. And this formulation was perfectly appropriate at a time when the ECB was seeking to establish credibility and too high inflation was its main worry. As our research shows, it was a key factor in successfully capping inflation expectations. But things have changed, and in the current environment of lower inflation, the concern we face are different, and this needs to be reflected in our inflation aim. Ensuring that there is sufficient space above zero to re-empower conventional monetary policy becomes more important. And to underpin inflation expectations, we need to ensure that our aim is perceived to be symmetric by the public. So we should have an inflation aim that is credible and that the public can easily understand. The second issue is the horizon over which price stability should be achieved, which is captured by the ECB's medium-term orientation. This forward-looking orientation reflects traditional and well-established principles of prudent monetary policy, which is consistent with the notion that monetary policy works with a lag and can influence inflation over the medium term rather than the near term. But within the ECB framework, the medium-term orientation has also been a way for the Governing Council to take into account what is happening in the real economy, including employment. We have a hierarchical mandate with price stability at the top. But the medium term, which is a flexible concept, allows us to avoid unnecessarily constricting jobs and growth in the event of a supply shock, which temporarily pushes inflation up and generates an economic slump. The low inflation environment, nonetheless, creates some new questions about how to operationalize the medium term. For instance, the existence of large and persistent disinflationary shocks related to, say, the ability to compare prices more actively via the internet and diversify suppliers is likely to call for more flexibility. But a persistent failure to meet the inflation aim can feed into inflation expectations and would call for a shorter policy horizon. We also need to reflect on our two-pillar approach for assessing developments in the economy, which uses both economic and monetary analysis. Cross-checking between the two helps determine the risks for price stability. The monetary pillar could in principle be enhanced to provide information on financial stability, which over longer time horizons could be relevant for the inflation outlook. Some central banks have also considered adding a backward-looking element to the policy horizon in response to the low inflation environment. In the ECB's case, the reference to underlying inflation dynamics in our forward guidance means that we already look at the past when deciding whether to change policy. The wider discussion today, though, is whether central banks should commit to explicitly make up for inflation misses when they have spent quite some time below their inflation goals. If credible, such a strategy can strengthen the capacity of monetary policy to stabilize the economy when faced with the lower bound. And this is because the promise of inflation overshooting raises inflation expectations and therefore lowers real interest rates. While make-up strategies may be less successful when people are not perfectly rational in their decision, which is probably a good approximation of the reality that we are in, the usefulness of such an approach could be examined. The third issue is the measure of inflation that lie behind our inflation aim. The HICP has served us well so far and is continuously being improved. Examples of these improvements include how it accounts for quality change, annual changes in consumption weights, more granular categories of expenditure, and timely data. But at the same time, our economies are changing increasingly quickly. We need to keep track of broad concepts of inflation that capture the costs people face in their everyday lives and reflect their perception, including, for instance, measures of owners-occupied housing. Now, it is not about moving the goalpost for monetary policy where it is suitable. It is about future-proofing how we measure inflation. But we also need to recognize that adjustments will have issues in terms of reliability and frequency of data. Likewise, to get a better sense of the evolution of the HICP over the medium term, we need to complement our analysis also by looking at more cyclical and less volatile measures of inflation, such as underlying inflation. The public rightly expects us to defend the purchasing power of money, and that is why we target the overall HICP. But underlying inflation measures are more responsive to economic slack, more to that in a minute, and tend to better predict inflation over the medium term. Let me now turn to the relationship between inflation and the real economy. If the anchor for inflation is the inflation aim, the Phillips curve plays a central role in allowing central banks to steer inflation towards that aim. But in the low inflation environment, prices appear to have become less responsive to the real economy. ECB research suggests that the empirical Phillips curve remains intact, but it may be rather flat, as we have seen. I'm going to borrow from George Bernard Shaw at this point in time. He's the one who said, "The reasonable person adapts themselves to the world. The unreasonable one persists in trying to adapt the world to themselves." And I'm sure that we can all agree that we should try to be reasonable rather than unreasonable. Broadly speaking, three factors might explain why inflation responded so weakly to improvements in the economy in the run-up to the pandemic. The first possibility is that economic slack, that is the amount of underused resources in our economy, was actually larger than we thought. The second possibility is that the relationship between slack and inflation was obscured by persistent structural forces. And the third is that the anchoring of inflation expectations might have loosened, affecting where inflation settles when both demand and supply shocks have passed and slack converges at zero. The intuition behind the first factor, slack, is that the Phillips curve is alive and well, but the euro area faced a series of large shocks that made it harder to measure economic activity relative to potential. And since what matters to move inflation in the Phillips curve is the distance from full employment. If that distance is underestimated, inflation may remain subdued even as measured slack gets smaller. There are numerous potential causes for mismeasurement, including measures of unemployment that ignored the effects of part-time work and underemployment, revisions to potential output which mistook cyclical change for structural trends, or a failure to fully account for external factors that added to euro area slack, such as relative demand imbalances linked to trade surplus. Research supports such a role for hidden slack, and since 2011, studies that assume that the output gap has been much larger have in general outperformed those that use traditional estimates. What is striking, though, is that in the run-up to the pandemic, we saw labor markets slack diminishing and wages finally rising, but without inflation picking up. In fact, ECB research finds that there was no missing wage inflation in the recent years. What we saw instead was a slower pass-through from wages to prices because companies preferred to compress margins rather than pass on cost rises. Now, for monetary policy, it matters whether firms did this because they expected slowing demand or because they were affected by persistent structural changes that distorted historical regularities. And that brings me to my second factor, long-running structural forces. How could they have weakened the link between the real economy and inflation and thereby require a revised approach to monetary policy? It is clear that globalization has lifted the global labor supply, has sharpened competition, and has caused firms to set prices more strategically. Globalization also went hand in hand with digitalization, which increased price transparency and enabled many industries to reduce their costs. In theory, all these factors could have depressed price inflation, even as wage growth was being supported through productivity gains from technology. In parallel, adverse demographics in advanced economies may have led to higher saving rates and structural weaker demand. Research suggests that these forces have affected inflation in the euro area in recent decades. A recent study finds that global factors such as global commodity prices, global slack, and producer price competition can all significantly affect inflation. ECB research also finds that digitalization has been disinflationary in the euro area. Since 2006, e-commerce has led to an average yearly decrease in non-energy industrial goods inflation of 0.06%. And empirical evidence suggests that a shrinking working age population may depress inflation. That's for the disinflationary forces. At the same time, structural forces need not be net deflationary, particularly in the aftermath of the COVID-19 pandemic. While globalization and digitalization have tended to pull in the same direction over the last 20 years, it is conceivable that they might now pull in opposite directions. The pandemic might both trigger deglobalization, as we see protectionism rise and firms shorten their supply chain to increase operational resilience, and accelerate the expansion of the digital economy. Changing global demographics might also reduce the global labor supply. In addition to that, a more active counter-cyclical role for fiscal policy after the pandemic may strengthen inflation dynamics. And we have to factor in a renewed focus on mitigating climate change too, which could have an impact on inflation through progressive changes in the energy mix as we transition towards a carbon neutral economy. Climate change affects all aspects of monetary policy, output and inflation, long-term interest rates and policy transmission, and that is why we are carefully studying the implications of climate change for our primary objective as part of our strategy review. In any event, structural factors can only have a lasting negative impact on inflation if they seep into inflation expectations. And this leads me to the third factor that may explain the apparent disconnect between the real economy and inflation. Empirically, it is not straightforward to gauge the anchoring of inflation expectations. They can be differing interpretations depending on the approach used to define anchoring, as well as the measure and horizon of inflation expectations considered. That said, market-based measures of longer-term inflation expectations have fallen, notably, even when adjusted for various risk premia that can distort the picture. Those measures have also become more responsive to short-term news, which can be interpreted as a sign that the anchoring has softened. Survey-based measures remain more or less within a range which is consistent with the ECB's aim, that is between 1.7% and 1.9%, although they have moved to the lower end of that range since 2019. For the actual process of setting wages and prices, it is the expectations of the public that matter most. Since our last strategy review in 2003, there has been more research on how consumers and firms form their inflation expectations. And while data are still scarce and noisy, the general picture is that consumers hold diverse, very diverse expectations about inflation that appear far less well anchored to our aim than other measures of inflation expectations. In 2015, for instance, average perceived inflation among euro area households was just under 5%, while actual inflation was 0.3%. The generally higher level of household expectations is not necessarily a cause for comfort, though. What emerges from the research in this area is that households take a long time to absorb new information on inflation, but when their expectations do adjust, they can be hard to dislodge. And the direction in which people perceive inflation to be heading can affect their economic decisions. Now, this process, of course, is not exogenous to monetary policy. It is greatly influenced by the central bank's objective and how policy is conducted and communicated in the pursuit of that objective. This is why the discussion of the numerical definition of price stability and on the instruments that can support it over time is so important. And clearly, the three factors that I have just discussed are not mutually exclusive. So it is crucial that we get a much deeper understanding of their relevance and their interactions in order to draw appropriate conclusions for how we conduct our monetary policy. As part of this, we need to understand how they might have interacted with monetary policy approaching the lower bound. And that brings me to my last and final area that I would like to discuss today, which is monetary transmission and effectiveness. As monetary policy everywhere has approached the lower bound, all major central banks have faced questions about their policy space and the traction of their tools on the economy. A key challenge has been the long-term fall in estimates of the natural interest rate. Let me just unpack that a bit. The natural rate is the unobservable interest rate that brings desired saving and investment into balance, or put another way, output close to its potential. Monetary policy is accommodative when the policy rate is below the natural rate, and restrictive when the policy rate is above it. Estimates for the natural rate in the euro area have dropped from anywhere between 0.6% and 2.2% on average from 1999 and 2011 to between minus 1.3% and 0.5% after that. And this has required progressively to lower policy rates in order to ease monetary policy, or even just to prevent that an unchanged policy stance becomes more restrictive. Central banks around the world have shown that this is not a barrier to stabilizing the economy. Before the pandemic, the ECB was able to offset the effect of a declining natural rate by taking its deposit facility rate into negative territory and by deploying forward guidance and asset purchases to ease financing conditions at longer maturities. Indeed, asset purchases, by compressing longer-term bond yields, can induce an easing of financial conditions that can partly compensate for the diminishing scope for conventional policy rate cuts. We also launched a series of targeted longer-term refinancing operations to strengthen the pass-through of these measures via banks to the real economy. And the effects on both financing conditions and the real economy was indeed significant. Considering all the measures taken since mid-2014, the overall impact on euro area real GDP growth is estimated to have anywhere between 2.5 and 3% cumulatively until 2019, and the impact on inflation between 1.7 and 2% cumulatively over the same period. Looking closer to now, the response to the pandemic has provided further evidence of effectiveness. Our Pandemic Emergency Purchase Programme, the PEP, and the new series of TLTROs have proven to be powerful tools for stabilizing financing conditions and stimulating credit growth. According to our estimates, the measures we have taken since mid-March this year will increase inflation by around 0.8% cumulatively between 2020 and 2022, and to have increased GDP growth by around 1.3% over the same period of time. However, we have to reflect on what will happen if natural rates remain low and inflation remains subdued, meaning central banks have to continue to resort frequently to balance sheet policies to deliver on their mandates. And this scenario throws up two issues that we need to consider more deeply, and they are the two issues that I want to finally touch on. The first one is, what should be the standardized toolkit for a world where unconventional policy is normal policy? The implicit assumption since 2008 has been that policy normalization will mean returning mainly to interest rate policy and winding down unconventional policies. But if normal is closer to what we saw before the outbreak of the pandemic, and I'm afraid what we are seeing even more vividly now, we need to be prepared. We need to have a clear consensus agreed within the Governing Council after good discussions, and need to be understood by the public on what tools are available to us when inflation is too low, and how they should be systematically deployed in response to different types of shocks. So we need to further and deepen our understanding of the transmission channels of our different instruments and to evaluate their relative side effects, whether they're intended or unintended, as they work their way through the economy. A central question is the extent to which different tools are substitutes or complements and their potential non-linearities. That is, how their effectiveness might change over time or in different economic conditions. We already have evidence on substitutability. For example, our research finds that without the use of large-scale asset purchases since 2015, our DFR, our deposit facility rate, would have had to fall to around minus 2%, 200 basis points, to achieve the same path of inflation we observed. This is a level that would probably have triggered reversal rate dynamics, a situation where a rate cut becomes contractionary because it harms the business models of financial intermediaries and disrupts monetary policy transmission. Conversely, other instruments have displayed complementarities. Think, for example, of our TLTROs and our negative rate policy. The long-term refinancing operations have been able to leverage the power of the negative rate policy by channeling the stimulative impulse associated with sub-zero rates directly to banks. Unlike in a reversal rate scenario, this promotes credit creation because banks can borrow at very low interest rates under TLTROs under the condition that they lend on without hurting their profitability and impairing monetary transmission. The second and last issue that we need to reflect on is the interactions between monetary and fiscal policies. When central banks have to use balance sheet policies extensively, there is an inevitable strengthening of the interplay between monetary and fiscal policies. And this interaction works both ways. Fiscal policy empowers monetary policy by fostering demand, which brightens economic prospects for firms. This leads them to being encouraged to borrow and allows them to profit from to the full extent from monetary policy stimulus. And monetary policy makes fiscal policy more effective because when monetary policy is at the lower bound and committed to staying there via forward guidance on rates and asset purchases, fiscal multipliers are higher. Indeed, one explanation for the superior inflation performance of the United States relative to that of the euro area in recent times is that monetary and fiscal policies were more aligned in the United States. From 2013 to 2018, fiscal policy in the euro area tightened by around 2.5% of GDP, compared with a loosening of 0.8% in the United States. ECB analysis for the euro area finds that while monetary policy was supporting inflation during this period, it was being largely offset by demand headwinds. The implication is that in the current environment, both policies must remain expansionary for as long as necessary to achieve their respective goals. And in disinflationary conditions, when the economy is running short of its potential, the goal of each policy are naturally aligned. But it seems that there is always a but. If monetary policy and fiscal policy are interacting more closely, it raises important questions. Questions that probably will become even more acute in the aftermath of the pandemic. These include how to set policy in a world of possibly permanently higher levels of public debt, and what is the appropriate design of Europe's fiscal framework. This is the reason why, since restarting our strategy review, we have introduced a new work stream on monetary/fiscal interactions, precisely to address these questions. So let me conclude. I have tried to lay out some preliminary considerations that are guiding our strategy review. At this stage, as I have said at the outset, it is too early to draw any firm conclusions. So I have rather attempted to identify some of the key issues that the Governing Council will aim to address in the next few months. There is, however, one issue on which I can be decisive today, and I think all members of the Governing Council would agree with me. We must explain much better to the general public what we are doing and why we're doing it. And we must talk to people that we do not normally reach. This imperative has to cascade through all the elements of our review, our inflation aim, our inflation measure, and our tools and their effectiveness, and how we take into account new challenges that people actually care about, their housing cost, but also climate change and inequality. I'm fully committed to that. Monetary policy, in my view, can only be credible if we ensure that our goals are truly understood and shared by the people we serve. As an independent central bank, we are and we will remain accountable to them. I thank you very much for your attention.